G'day folks, welcome back to another update for commodities. Now, in our last video we did say there was a bearish divergence on a lot of these instruments that we're covering, and a lot of those targets have been hit. So we'll go through those individually on the charts. Before we go there, make sure you hit that like and subscribe button to support the channel. But as of today, July 28th, copper, structural energy transition demand underpins copper, but headwinds from weakening Chinese property demand and US tariff policy dampen sentiment. Goldman Sachs forecasts an average of around $10,100 per tonne in 2025, sharply down from the earlier projections. Iron ore prices are softening due to sluggish Chinese steel demand and rising supply from major producers, Australia, Brazil. Forecasts of 2025 average around US $80 a tonne, easing further towards $76 in 2026. Spot gold is consolidating technically and likely to be supported by persistent inflation, cautious central banks, macro uncertainty, and central bank purchases. Structurally benign to sideways bullish into third quarter and beyond. Silver up 36% year to date. Silver has surged to levels not seen since 2011, around $39.40, driven by industrial demand, PV, AI, defense, and tight supply. Analysts see further upside to US $42 an ounce in 2025, potentially spiking to $45 an ounce in 2026. For platinum, though less covered in recent reports, precious metals sentiment generally remains positive alongside gold and silver. Supply dynamics for platinum remain relatively stable, but demand for industrial and auto-related uses adds some support. US crude fundamentals remain bearish in the near term, with ample global supply outpacing modest demand growth. World Bank forecasts Brent averaging around $64 in 2025, declining to around $60 in 2026 amid weak demand and rising OPEC output. Also, don't forget to reference the +1 videos to get an insight into the trading strategies and the methods we use in terms of approaching some of these strategies and back testing we're going to be covering in this video. So for high-grade copper, on the monthly chart, you can see that the price is well above the moving average band, giving us a bullish momentum. Likewise, the CCI is above its moving averages. Now, we did have a bearish divergence back here. That was a few months ago, and the price has retraced down there and hit that 23-38% Fibonacci range on that bearish divergence on the monthly. That was also covered in our previous video, so no real news there. Now, the price is currently hitting this resistance at 59,560. And we'll see what it's doing currently in the lower time frames. So on the weekly, likewise also bullish, both price and CCI are above the moving averages. Although I do notice we've identified this fair value gap in red. So the price may well come back down and cover that area in the near term. This could take at least days, if not weeks, to cover. So let's keep an eye on that. You can see these other fair value gaps back here have all been touched and covered in subsequent candles. But at the moment, bullish momentum on the weekly. On the daily, again, hitting that resistance up there, we've identified this fair value gap from that high there right down to this point here. So that's a fair value gap which hasn't been penetrated yet. So we may very well see the price break down into that area in the near term. The CCI as well, you could possibly call that a double top on the CCI versus high highs in the price. In fact, I'll mark it, and I'll draw a target range for it. You can see there, that's pretty much maybe a bit slightly high, but I'd call it high on the price. And if we were to pull it back in terms of Fibonacci retrace, let's put it back to that level there. So you can see there, that'll come back down to that 23-38% range. So if I mark that, that's a minimum retrace we can expect for the price to retrace to. But more importantly, just notice if it does break in that area, it may go even further to cover these this fair value gap, which hasn't been touched yet. Now, if we go to the 1 hour time frame, we always look at the 1 hour period, even though you might be trading on the higher time frames, to see if there's any micro moves. And here we've identified a bearish divergence on our last video, lower highs on the CCI versus higher highs on the price. In our last video, I did draw this target, and you can see here the price is retracing back towards that. Hasn't hit it yet, but it's approaching that way. And notice the CCI is still dropping. So taking only trades in the direction of the higher time frames. If you're trading on the hourly, you want to wait for that to break above the CCI moving averages to take long positions. The price is already above. You just want to wait for that to break above as well to take long positions. And by that stage, we may see this break above this resistance on the 1 hour time period. Now, in terms of a back test, what I've done back here, I've started it back here from that point on that candle when the price is above the moving average, and so is the CCI, and that equates to this area on the 1 hour time period. So this is a stop loss approach, take profit of 3% and stop it at 0.5% stop loss, and this is the average down approach, take profit of 3% and average down when price drops by at least 0.5%, and the entry parameters are met again, and the entry parameters are basically when the CCI and the price break above the moving averages. Now, if I let it run through the whole period, you can see there the stop loss approach is about break even or just below the 100,000 mark, whereas the stop loss approach has generated a nice little profit. Now, in terms of closing out this, remember the main rules are you trade in the direction of the higher time frame, you close it out at the last stage when it touches that, the daily touches that moving average range. So ideally you should have, or more recently, you should have got out of the trade when the daily broke in that moving average on the CCI, which equated to this area here on the 1 hour time period. And then re-enter long entries again, and then close it out again when it entered in that moving average range. So you shouldn't be in the trade at the moment, you should be closing it out. But also notice on the lower time frame, you'd be paying attention to these bearish divergence, and you'd be getting out of the trade for each of these periods when you see this bearish divergence. And it's a good idea to zoom out like it is here. Sometimes if you zoom in too closely, it's sort of it's like looking at the bug on a windscreen. Sometimes you want to see the road ahead of you, in which case zoom out. You can makes it a lot clearer to see these bearish divergence. So there was one back here, you should have got out of a trade on that one there when you saw that bearish divergence and the price broke below the moving averages. So you would have got out of a trade there, then started taking long trades again, going long only in accordance with the daily, and then getting out of the trade again at this point here when you saw a bearish divergence. So you would have got out there on that period back there. And then lastly, you would have got out more recently, as I said, around this area here at that high there. So for iron ore on the monthly, there's no CCI for it, but you can see there it's below the moving average range, giving us a bearish momentum. Had a bit of a spike up towards that moving average range on the price, but still bearish according to the rules. On the weekly, it's already broken above the moving average of the CCI and the price. But notice here we've got a fair value gap identified down here, and a fresh one here was done recently, last couple of weeks, and it looks like it's actually retracing and covering that fair value gap as we speak. So we may well see it come back towards this fair value gap in the next few days or even weeks, depending on how long it takes. On the daily, we did have so at the moment, in terms of momentum, it's predominantly bullish, but again, just be mindful of it pulling back at the moment. And that's why we look at the lower time frames. And on the daily, we've got currently a neutral positioning. The price is bullish above the moving averages, but notice the CCI is broken into that moving average range. So avoid taking long or short positions. And again, similar to the weekly, the daily here is approaching this fair value gap, and it may well come back into that moving average range to fill those orders. If we go to the 1 hour time period, so again, even if you're trading on the daily, we always look at the 1 hour, see if there's any micro moves. And here we've got in our last video, we have had a bearish divergence versus higher highs in the price. We drew a target, that blue rectangle, and it's actually broken right past it. And it also is broken through that fair value gap, which was identified recently as well, the red one. So they coincided, which is always a high probability of the price reaching back towards that area, which it did. And it's currently, notice here, the price, it looks like it's still falling. The CCI is still dropping. So don't take short trades until we see this break below on the daily. So just stand clear until we see a more decisive positioning on the daily. In terms of the back testing, here I've started it going back to this period around the 26th of June. And that's where the price broke above the moving average range, and so was the CCI, and that's where you would have taken long positions. So the stop loss approach, you had a few trades there that generated small amounts, that one contract traded each time, $30, and this one's generated with an average down a couple of times, about 86. But again, notice when you start seeing these bearish divergence at each of these points, you probably would have got out of the trade once it started turning down. In fact, this one is a bit of a difference actually. Even though there's a bearish divergence on those peaks there, you'll notice the moving averages contract and then they widen again, contract and they widen until such time as they contract and then they widen to the downside. That's where you potentially start taking and closing out positions when you see a bearish divergence, as in this case. So back here, theoretically, you could have stayed in the trade with that contraction, because then it widened to the upside on both of those periods. Even back there, it was still contracting and widening to the upside. So for spot gold on the monthly, very strongly bullish on the price chart. There's no CCI for it. Although I do notice it's consolidating up there for a couple of months now, causing this wedge, and we may see the price pull back towards these fair value gaps. Now notice there how far away they are, right down to that support at 1732. So if, and I say if, they do come back down to that area, that could take years to play out. So don't go placing short orders based on that alone. We primarily look at the price where it is and the CCI above the moving averages. So at the moment, predominantly bullish trades. If you're trading on the weekly, we go in the direction of the monthly. On the weekly, we've also got that consolidation up there, as you can see, but we've also had a couple of bearish divergence. You can see there, both of those hit their, well, actually this one hasn't hit their target yet. This one's still untouched, but the CCI is still dropping, so we may possibly see a price break to the downside here and hit that range. And again, it could just touch that range and start bouncing again, or it could actually fall a lot further. So just be cautious about this one. I know there's a lot of people selling the prospects of gold and buying gold, but just be cautious. I'd like to see this break a lot higher along on the CCI to be more bullish. For example, you could have taken some long positions back there when the price is above and the CCI was above. On the daily, similarly, it's been consolidating now for some time, and we did see, we had a couple of fair value gaps there. You can see that was filled by those candles, and another couple of fair value gaps here since our last video, which has been filled as well. Currently, we've got another one that's currently being in process of being filled, that one there, and also that one there. So we might see a bit of a bounce shortly, but at the moment, predominantly bearish on the daily if you're trading the hourly, because the CCI is in the down below the moving averages, and so is the price. So just be cautious about this one. This is a pretty tricky one to trade actually, because it's in its consolidation period. But if we go to the 1 hour time period, we did draw this bearish divergence last time, and it's already broken through that before on our last video, and it's fallen a lot further. In fact, it's fallen way below the 61% if I drew a Fibonacci on that. So that was originally the 23-38% range, and this one's gone well below that 61%. So it's approaching the 100% retrace level. And it's currently somewhat bullish, but I'd like to see these moving averages turn up to be more confident, like it did back here, for example. You want to be careful it doesn't just have a false break to the upside, then starts continuing further to the downside. And that's why I'm showing you the wider time frames, so you get a better understanding. For example, on the daily, it possibly may fall a lot further. So just be cautious. I'd like to see these moving averages moving in the same direction as the price. In other words, I want to see the moving averages bend up like they were back here. Now with gold, what I've done is I've got the back test for the longs and also the shorts, only because of this consolidation. So here on the longs, for example, I've taken long positions from that period there on that candle when the price was above the moving averages, and so was the CCI. That's where the longs started for the stop loss approach, generating about 5,300, and the average down approach generating about just short of 30,000. And again, I'm not telling you to hold it out through the whole period. You always pay attention to the daily trend and where it's going, and close it out when the CCI touches that moving average range to the downside, in this case going long, but also monitor any divergence on the 1 hour chart. So for example, going long, if you notice here, you've got a bearish divergence. As soon as you start seeing the price break below the moving average on that bearish divergence, you close it out somewhere around that period there. And also remember to zoom out, get a wider picture of the chart to get an understanding. So where we are at the moment, for example, going long, you would have got out of the trade around about that point there, and you would have avoided that downfall or the price and the CCI dropping off. In terms of short position, so that's the long positioning. In terms of short positionings, again, we're doing it because of the price is going sideways at the moment, giving us an uncertain direction. The short positionings here have started around about the 9th of May. So that's around this area here, where the price started breaking below the moving average, and so did the CCI was below the moving average. So here in this case, the short stop loss approach is about break even, about $240. And the average down approach is generated about 20,200. But again, notice the direction. So if you're going short, you'd be avoiding these periods where the prices and the CCI is moving to the upside. And what you do is you try and find any bullish divergence, but also at the very latest, you get out of the trade, for example, when the going short, when the price breaks into that moving average range on the daily, you get out of the trade on the 1 hour time period. In this case, for example, there, going as a bullish divergence, you'll get out of the trade on that point there when the price breaks above that moving average range after that bullish divergence. So for platinum on the monthly, very strongly bullish momentum on the monthly chart, price above the moving averages. No CCI for it, but do note we've got a fair value gap down here near the moving averages, so we possibly may see a pullback on that one on the monthly, so just be aware of that. Again, we don't trade those, we just look at it as a potential area of in this case, a support level. On the weekly, it was bullish, but notice it's broken down into that moving average range, so causing a neutral positioning. The price seems to be consolidating in that wedge, so avoid going long or short until we see a more decisive move according to the price and the CCI movement above or below the moving averages. At the moment, it's neutral. Also notice this fair value gap down here on the weekly. On the daily, we've got this declining CCI, still bearish, and the price is still above the moving averages. So avoid long or shorts on this one, but do note we've identified let me just zoom in for a moment. We've identified a bearish divergence target, a 23 to 38% target. So you may see the price come back towards that range, and more than 90% of the time it hits that range. Sometimes it falls right through, but that's our 38% Fibonacci retrace. And back here I've identified this, what's called a fair value gap on all these areas because they haven't been filled with orders yet. So we may see the price fall a lot further than this bearish divergence target. So just be mindful of that. But at the moment, avoid trading until we see a more decisive move, as I said, above the moving average ranges on the CCI and the price. On the 1 hour time period, even if you're trading on the daily, the 1 hour, again, it's been dropping off. In this case, you would not be trading anything on the 1 hour because the daily is showing you a bearish CCI versus a bullish price. So you want to avoid trading until you see a more decisive move above the moving averages in this case to go long on the 1 hour time period. Remember, you don't have to be in every trade. So if the chart doesn't show you any proper indication, stand back and don't take any trades just to avoid any mistakes you might make. We did have a bearish divergence back here, drew a target before our last video. They'd already hit it. In this case, it's fallen a lot further. And if I was to draw a Fibonacci on that, just to measure how far it's actually gone, that's at 38% range, and it's gone below that 61% range. Currently bouncing out of that. So again, we'll see that it looks like it's already completed that divergence. So we'll see how far it does go to the upside possibly, and by then we might see the CCI break above on the daily as well. Now in terms of a long positioning, what I've done here, I've started it back from the 16th of April. That's where you would have started going long. When the price, in that case, broke above the moving averages, and so did the CCI, you would have started taking long positions back at this point. The stop loss approach has generated 9,100 roughly, and the average down has generated 71,000 approximately. Again, I'm not saying you let it run through the whole period if you're doing that, but always pay attention to whenever the price, in this case, retraces to the downside, for example, and you would have got out on the daily when the price touched that CCI there, and do note how that would have been near the top there of that little price range. And that CCI gives you an early exit signal rather than waiting for the price to break into the moving averages. And you would have entered another long position once it broke above on that candle. So don't stress about losing any profitability in that little range. Just follow the rules, and they should work for you profitably. Also do note, as well as following the daily trend and closing out positions when the CCI touches the moving averages on the downside if you're going long, also take note of any bearish divergence. And back here we had a bearish divergence. Again, zooming out. Once that CCI starts dropping along with the price, you would have got out of the trade on that one and wait for the CCI and the price to break higher again to go long. Again, there's another couple of bearish divergence there. You would have closed it out on that one, and so on. You get the idea. And more recently, there was a bearish divergence here, and you would have closed it out near the top there. So for silver, on the monthly, first off, the price is well above moving averages, and so is the CCI, so taking long trades only on the weekly. The weekly is also showing bullish momentum on the price, but do note the CCI is pulling back towards that moving average range, so we might see a pause in the short term if that touches that moving average range. See here in the last few weeks it's been consolidating, but do note also how we've got these fair value gaps down here, so we may see the price pull back into that range possibly in the coming weeks. So just be aware of those. On the daily, we had another bearish divergence here. We anticipated in our last update. We drew a target there. Notice since our last update, the price has dropped strongly, covered that fair value gap, that short-term fair value gap there on the daily, making a bit of a bounce at the moment, but notice the CCI is still bearish, so avoid taking long trades until we see they break more convincingly to the upside. On the 1 hour time period, so even if you're going long, you want to make sure that the 1 hour is showing you a bullish momentum, which is not in this case. We did draw a bearish divergence here on our last video, drew a target, and that's actually hit it on the 1 hour time period. The CCI is still dropping, although it's currently making a slight move to the upside, but the price is still below the moving averages. So again, uncertainty at the moment. Avoid trading until we see a more decisive move. On the main reason you want to make sure it's going to the upside on the daily with the CCI breaking above, the price is already there. So only take long trades when that breaks above on the daily, and the 1 hour is also bullish at the moment, undecided on both the daily and the 1 hour. Now in terms of the back test, I've started it back there just for reference around the 16th of April, and that goes back to when that candle broke above the moving average range, and so was the CCI. Now, strictly speaking, you want to make sure that the price is, the moving average band is bending up like it was here. I'm just showing you the demonstration of how it works. You still would have been okay in this case. Now, it doesn't always work that way. Sometimes it's a false break. That's why I always say make sure the moving average band is also trending up as well. But in this one, the stop loss approach is generated about 5,300, and the average down approach is generated about 125,900. Again, always close out, if you go, in this case going long, always close out your positions when the daily CCI touches the moving average band, but also look out for any bearish divergence, and there were quite a few in there, a couple in there, and you would have closed it out, for example, at that point there, on that point, going long again on a few more trades, and then closing it out more recently when you saw this bearish divergence on the 1 hour, which I demonstrated on the previous chart, when that price breaks below and the moving averages start bending down, so you would have got out there and avoided entering those contracts. So for US crude on the monthly, it's bearish below the moving averages, and the price made a bit of a bounce, but currently still bearish below the moving averages. So bearish momentum on the monthly. Do note we've got these two fair value gaps on the monthly, a lower one down here and one up here near that resistance area at 94.25. So the price could go either way at this point, but at the moment you can see the trajectory of those moving averages is still trending to the downside, predominantly for US crude on the monthly. On the weekly, we did have a break above the moving average on the weekly, and also on the CCI, but notice currently the CCI is broken into that moving average range, but also note the moving average band as well is still trending down. That's the other thing about these moving average bands as well. You'll notice when they do contract like it did here, they give you an indication of consolidation, whether it's price or CCI, versus single moving average lines, because you don't really, if that was a single moving average line, you couldn't really tell if it's consolidating as easy as seeing these moving average bands. But at the moment, neutral positioning, meaning don't take any trades if you're trading on the daily, because the weekly is not decisive. That fair value gap's been touched with these candles here, and we've got a little fair value gap down there which hasn't been touched yet, so very likely we're going to see that in the coming days or even weeks. On the daily, we've got, first we look at the trend, again that contraction of those moving averages, but it's still bearish. The price and the CCI is below the moving average band, but do note we've got this wider fair value gap which hasn't been touched yet. This one back here has been touched with those candles, so they're okay. But this one, so you might see a bit of a bounce in the short term on the daily to the upside possibly, but again, don't trade that. We trade in the direction of the moving average bands. On the 1 hour time period, so you can see there the price is pretty much still zigzagging, roller coaster effect, nothing really decisive. So stand clear. This is undecided. At the moment, it is starting to break to the upside, but notice the moving average bands are still somewhat not aligned. In other words, they're not really going anywhere. And that's mainly due to the daily giving us this contraction at the moment on both the CCI and the price. So avoid trading on this one. However, just to demonstrate the effects of going long, and I've gone long here, going back to about the 12th of May. When the price, around that point there, when the price and the CCI broke above the moving average bands, you would have taken long positions from there, predominantly, and you probably would have started taking short positions from that point, but I won't demonstrate that for the sake of time. But here again, taking note of any divergence, closing out your long positions, and also making sure you don't trade when the CCI on the daily touches the moving average band. So I won't go through all those, but you get the idea. Again, more bearish divergence there. You would have closed it out near the top there. And closer here, there was another bearish divergence, and you would have closed it out somewhere there as well. At the moment, you would have, last long trade you would have possibly taken was maybe there, but again, notice the daily is consolidating, not giving you a clear indication, so you should not be trading this one at the moment. Remember, don't forget to reference the +1 videos to get a better understanding of strategies and different types of strategies we backtest. So thanks for watching. Hit that like and subscribe button, and we'll talk to you in our next video.